As Flow grows, Neumann again positions himself at the front of a story about reinventing how people live and work. Whether the outcome is another multi-billion-dollar cautionary tale or a genuine transformation of residential living remains uncertain. What is clear is that the founder's second act is already large, already valued at billions, and already backed by powerful institutions. The more pressing question now is not if Adam Neumann rises again. He already has. But who absorbs the risk if his latest project falters? Is this reinvention evidence of genius, or of a system that enables reinvention without accountability? Workers, landlords, or investors, who paid? When WeWork entered bankruptcy in late 2023, the conversation quickly turned to numbers: billions in losses, balance sheets in tatters, and investor write-downs. But the reality of who paid was far more complicated. Tens of billions works as a headline, yet the damage broke down into smaller, sharper consequences for very different groups. Landlords suddenly missing payments, workers finding themselves unemployed, and small tenants forced out of spaces they depended on. Large funds could treat losses as a cost of doing business. Everyone else had to feel them directly. For landlords, the fallout was immediate and punishing. WeWork was not a minor client renting a floor or two. It often signed huge multi-year commitments, sometimes entire towers, based on rents above the market average. Those agreements became part of how property owners valued their buildings and secured loans. When WeWork's bankruptcy restructured the business and canceled roughly a third of its leases, that foundation collapsed. Court filings showed some landlords, like Beacon Capital Partners, among the top creditors, owed millions in unpaid rent and termination penalties. In the UK, WeWork's subsidiaries reported heavy pre-tax losses linked to more than £800 million of debt owed to the parent company, highlighting how deep the exposure ran. Each broken lease was not just a missed payment, but for owners, a direct hit to building value and a threat to financial stability. The closures were sweeping. Roughly 150 leases were maintained, 150 renegotiated, and another 150 were exited entirely. Taken together, it was the equivalent of pulling hundreds of large tenants out of city centers across the globe. Prime buildings in London, Manchester, New York, and San Francisco suddenly had entire floors returned to the open market, often at rental levels far lower than those that WeWork had once promised. For landlords, there was no way to claw back the years of inflated projections they had banked on. Debt lined up against those estimates still needed servicing, while their anchor tenant vanished. It became a textbook case of contagion. One unstable renter spreading financial stress across dozens of otherwise unrelated buildings. For employees, the story was one of attrition. Layoffs began well before bankruptcy. In 2019, during the company's first round of post-IPO damage control, 2,400 workers were let go, nearly one-fifth of the global staff. Thousands more cuts followed over the next several years as the company shrank, narrowed operations, or exited markets entirely. The slow downsizing left waves of workers, many young professionals drawn in by promises of growth and community, suddenly jobless. For many, those jobs were not easily replaced, particularly in commercial property and customer-facing service roles where industry-wide demand was already slipping. For staff, it wasn't a distant financial adjustment. It was the loss of their paycheck, healthcare, and often their immigration sponsorship. The collapse also seeped outward to freelancers, startups, and small companies that had woven WeWork into their daily operations. For many, the appeal had been straightforward: a central address, reliable spaces to meet clients, and access to professional environments without long leases. When branches from London to North America were closed with little warning, these small tenants were forced to improvise. Some switched to other co-working providers, though at higher costs or less convenient locations. Others scaled back operations, shifting home or online permanently. The disruption went beyond lost deposits or deposits. It stripped away stability, forcing small businesses that could least afford it to rebuild their routines on short notice. Meanwhile, investors ate their own form of loss, though at a different order of magnitude. SoftBank, the single largest backer, saw billions vanish from its balance sheet. Sovereign wealth funds and pensions tied to its Vision Fund absorbed those write-downs as well, though for them, the numbers were spread across vast portfolios. Paper losses in a capital pool worth hundreds of billions stung reputationally, but were not as immediately disruptive as a landlord facing mortgage payments on a half-empty tower. When the bankruptcy restructuring passed through court, lenders and new backers like Yurdi Systems ended up taking equity control. About $4 billion in debt was erased and roughly $12 billion in future rent obligations wiped. Moves that locked in deep cuts for landlords but gave creditors fresh ownership of a slimmed-down company. What the process laid bare was the hierarchy of who counted most. Lenders came first. Creditors exchanged debt for equity and secured future rights over the company. Investors shifted losses into financial reports and balance sheets. But landlords, owed unpaid rent, and employees, waiting for severance that might never come, were left further down the line, absorbing immediate damage without clear recovery. Even Adam Neumann's attempt to buy back WeWork through new financing offers was rejected in favor of creditors keeping control. The rules of bankruptcy made priorities explicit. Institutional lenders had leverage. Those left distributing mail without addresses or working in offices where jobs disappeared overnight did not. Distinguishing the uneven burden is key. Large capital pools absorbed WeWork as a bad bet, written down and moved aside while other portfolio companies offset the loss. Sovereign funds and pensions felt it on paper. But for smaller stakeholders, it was not abstract. It was obligations due each month without the tenant income they had expected, or careers derailed after years of heavily advertised community and culture. Landlords renegotiated at weaker terms or pursued lawsuits, but the value had already evaporated. Workers carried the costs in unemployment and career instability. Small tenants rearranged entire structures of how they operated. The gulf between those with financial hedges and those without could not be clearer. The closure also reflected a broader truth. The very groups least responsible for WeWork's collapse often paid more dearly than those most involved. The investors who enabled excess capital could retreat into diversified strategies. The people who had little say in management decisions, employees and tenants, felt the shock with the least insulation. The hierarchy of costs made plain the imbalance in venture-backed collapses. Financial power softens blows, while ordinary participants absorb them head-on. At the end of the bankruptcy process, 3 answers emerge about who paid. Investors lost billions through write-downs, landlords carried the strain of unpaid rent and reduced property values, and workers and tenants saw jobs cut, businesses displaced, and workplace routines fractured. Together, those 3 outcomes define the actual cost of WeWork. Not just capital incinerated on balance sheets, but the destabilization of livelihoods up and down the chain. This is what makes WeWork's collapse more than just another failed startup story. It highlights how venture-fueled excess reshaped cities, employment, and small businesses before circling back in losses. And it raises an open question for the people who fund and fuel these experiments. When experiments on this scale fail, does anything actually change? The wider venture capital lesson. Ignored? Was WeWork's downfall enough to change how Silicon Valley thinks about risk? Many hoped it would be, given the scale of the failure and how clearly it exposed the dangers of mistaking vision for substance. Billions in losses and empty offices were hard to ignore. Commentators described it as a turning point, a definitive reminder that hype cannot sustain a business forever. For a time, the rhetoric suggested something had shifted. Investors promised tighter governance, more scrutiny of founders, and a commitment to fundamental numbers over slogans. Yet looking at what followed, it seems the discipline was short-lived. Patterns of narrative-driven investing soon re-emerged in the very sectors attracting the most capital. The most immediate proof came with the rise of artificial intelligence as the dominant investment theme in 2023 and 2024. Within months of WeWork's bankruptcy, venture firms that once dismissed cautious betting were committing hundreds of millions to startups still building their basic infrastructure. Slide decks and valuations once again leaned heavily on abstractions, just as WeWork had leaned on talk of operating systems and consciousness. Some founders promised AI would transform logistics, medicine, even entire industries. Projects with little revenue were closing rounds north of $100 million. Early-stage startups were being valued like mature tech giants. The tempo felt familiar. Where WeWork defined the 2010s with talk of community and exponential office demand, AI carried the new decade's promise of emergent intelligence and unlimited potential. That doesn't mean nothing changed. In the wake of WeWork and crypto failures like FTX, venture firms made an effort to highlight due diligence. The phrases governance reform and board oversight began appearing more frequently in investor letters. Firms talked about balancing founder charisma with experienced directors and pointed to improved auditing practices. On the surface, there was recognition that unchecked power posed clear risks. But beyond the words, evidence of serious structural tightening is thin. Auditors may be hired sooner, but large checks still flowed toward companies shaped more by story than spreadsheet. SoftBank's Vision Fund remains the clearest symbol of how exuberance can distort judgment. Its $100 billion mandate essentially required a hunt for massive deals, regardless of whether the companies involved could show profit paths. WeWork became its crown jewel only, later to collapse into one of its largest write-downs. Reports from the time noted multi-billion-dollar losses across the portfolio and questioned Masayoshi Son's hunch first, numbers second style. Publications from Bloomberg to Fortune treated WeWork as proof that his approach had crossed into recklessness. In theory, this should have served as a corrective for other venture investors. In practice, many seemed eager to distance themselves from SoftBank's mistake while still replicating the same enthusiasm in new areas. The dial shifted in language, but not in behavior. Interest rate hikes between 2022 and 2024 added another complicating factor. Borrowing grew more expensive, slowing some late-stage growth rounds. This could have enhanced caution, as access to cheap leverage had been central to some of the largest bets of the previous decade. Instead, capital simply flowed into what investors considered generation-defining opportunities, particularly AI. The rationale echoed WeWork-era logic. Grab scale first, establish dominance, and then worry about profits. The lesson of fixed costs outweighing revenues. The truth that doomed WeWork's office empire was not applied broadly. Investors rationalized risks by focusing on potential upside, convinced that missing an AI breakout would be more dangerous than funding another spectacular collapse. Shifts in the IPO market also revealed how little had changed. The WeWork saga highlighted the dangers of companies staying private for extended periods, inflating valuations worth tens of billions before public investors could weigh in. Once public markets drew their own conclusions, valuations collapsed. After early warnings from Uber and Lyft's post-IPO stumbles, WeWork turned the concern into scandal. The hope was that venture firms would adjust, pushing companies to reach profitability sooner or accept lower private valuations. Yet by 2025, many startups are still staying private longer, raising cash at aggressive multiples while promising sustainable models only after expansion. The structural mismatch between private exuberance and public reality persists. This illustrates a recurring rhythm in venture capital. After a major collapse, the industry adopts temporary caution in its language, pointing to updated diligence processes, highlighting governance, and publishing thought pieces about discipline. Then, when a new market narrative captures attention, capital surges in regardless of whether fundamentals have caught up. It is not that every firm ignores lessons. Some portfolios genuinely exercise tighter oversight. But broadly, the draw of the next big thing overrides restraint. The pace of funding rounds, the valuations awarded, and the willingness to bet on grand visions bear the same signatures visible in WeWork's rise. From a personal finance perspective, this cycle matters because retail investors encounter the effects when private hype finally meets public markets. Inflated valuations in late-stage ventures translate into overvalued IPOs, often followed by sharp corrections once figures are subjected to greater scrutiny. The WeWork IPO collapse exemplified how this plays out. For individual investors, the practical point is clear. Do not mistake narrative for durability. Be cautious of private market valuations, particularly when they seem disconnected from revenues, and remember that public disclosures offer more reliable signals than founders' slogans. WeWork's legacy in the investment world sits somewhere between warning and footnote. On one hand, it is cited continuously as the largest venture-funded real estate disaster in history, a lesson in what happens when due diligence falters. On the other, its specifics are often brushed aside as unique to one eccentric founder and an unusually aggressive backer. That framing lets firms treat it as anomaly rather than symptom. By calling WeWork an outlier, venture capital as a whole can continue chasing narratives with only superficial nods to discipline. By 2025, the scale of AI funding suggests this is exactly what has happened. Multi-billion-dollar rounds for early-stage startups suggest that investors remain willing to price companies as market-dominating forces before business models are proven. The slogans and key phrases are new, adapted to the language of neural networks and synthetic intelligence. Beneath that, the structure of chasing growth first and justifying fundamentals later hasn't shifted. Governance concerns that loomed so large in WeWork's story remain overshadowed by fear of missing the next breakout success. This doesn't mean every venture firm has ignored lessons. Some have adjusted practices, diversified strategies, or imposed stricter metrics. But the broader trend points toward a system where collective memory is short and enthusiasm repeatedly wins over caution. For those watching from outside, the warning is simple. When evaluating opportunities, especially ones that carry inflated private valuations, be alert to whether the story exceeds the numbers. If the answer is yes, history suggests the downside risk is far greater than flattering projections admit. And that leaves an important closing question. If capital markets continue rewarding stories above financial discipline, what's the practical rule for your own money? What it means for the future of offices? If WeWork's collapse proved anything, it's that the failure of one company doesn't equal the death of an entire industry. The obvious question that followed was whether co-working itself was finished. The answer is clear: no. Co-working survives, but informs very different from the billion-burning experiment that tried to dress office rentals as a global movement. Demand for flexible offices continues, just not at the scale or with the slogans that fueled WeWork's implosion. Companies still want shorter terms, adaptive layouts, and spaces they can scale up or down with minimal penalty. What didn't survive was the illusion that free kombucha and branding could turn desk rentals into the next Facebook. The difference between models matters. Legacy operators like IWG have run steady, profitable co-working networks for decades without chasing spotlight valuations. Their strategy has always been cautious growth and measured returns, keeping attention on occupancy rates and cost discipline instead of myth-making. At the other end, small boutique providers target niche groups. Legal firms that need credibility downtown, creative hubs tailored with studio space, or suburban co-working sites offering a closer option for remote staff. These operators don't claim world-changing missions. Instead, they focus on aligning space supply with predictable demand. That distinction, real estate math versus tech fantasy, explains which co-working firms endure and which don't. The market itself continues to evolve. Research from JLL and others shows flexible offices are now claiming a larger share of total space in multiple cities because occupiers prize agility. A 2023 analysis by the Instant Group found U.S. desk demand down 5% from the previous year, but still 25% higher than before the pandemic. The message isn't that co-working is fading. It's that it has stabilized at a stronger baseline than many expected. On the other side of the Atlantic, JP Morgan projects a shortage of prime office space in London, predicting demand could run nearly twice as high as available supply by the mid-2020s. Within that climate, flexible workspaces slice of the market is expected to grow from 6% in 2020 to nearly 30% by 2030. A striking shift that shows the sector is alive and expanding, even if more cautiously. What tenants want now reflects lessons learned during the pandemic. Remote work normalized independence, but employees returning for at least part of the week often do so reluctantly and with new demands. Comfortable interiors, natural light, communal areas, and strong connectivity matter more than rigid rows of cubicles. Analysts call this the hotelization of the workplace. Space is expected to feel closer to modern hotels than corporate corridors. Flexible space operators already excel in this area. Many of their buildings were designed with open lounges and informal layouts. That turn has become their advantage, tailoring environments to collaboration and productivity rather than just square footage. Another factor shaping demand is ESG performance. Many firms commit publicly to reducing carbon footprints or improving employee wellness. Lease decisions are now weighed against environmental targets, which means workspaces with efficient energy use, reusable materials, or wellness certifications fetch a premium. Flexible office providers that can retrofit quickly meet this demand better than landlords tied to inflexible multi-decade leases. In other words, sustainability has become a selling point that protects revenue streams in leaner times. For co-working firms, meeting ESG goals doesn't justify wild valuations, but it does create resilience. In the US, the outlook remains mixed. Overall demand for space is lower because large employers no longer need as many desks.